Hi, Matthew Plummer with MVP Realty Group in Olympia, Washington. You know, over my career, I've had lots of people approach me wanting to become real estate investors. Maybe they saw a late night infomercial or an ad pop up on their social media. You too can be a real estate investor. It doesn't take any money, nothing, no know-how, all of that. And then they come to me and they say, but I can't get the numbers to work. I can't get it to pencil, which essentially means at the end of the month, when they collect the rents and pay out all the expenses to include their mortgage payment, they're not making any money. Well, and that's the reason for that is because there's a difference between cash flow and property performance. Property performance is something that we can do regardless of you. You know, it doesn't involve the investor. It's really just about the property. Cash flow is what helps you determine whether or not you're an investor. Because if you can't invest enough, your cash flow won't be there. And so let's just use an illustration. Let's look at a $450,000 duplex. And each side of the duplex brings in $1,500 rent every month. We combine that to make $3,000 per month, and then we always look at everything annually, so that's $36,000 per year in gross income. Now we all know you don't get to keep all that income because, well, you've got taxes, you have insurance, you have repairs that'll inevitably come up. Heck, you even have vacancies. You know, you turn somebody over, it might take a week or two of income out of your annual income. So if you don't know the exact expenses involved in a particular property, a really good way to rule of thumb evaluate a property is to consider 25% of the income gone. So you're dealing with just 75% of the gross income, which we refer to as your net operating income, your NOI. And once you have that number, now we're ready to start determining the performance of that property, because what we do is we relate that number to the acquisition price of the property. We take that net operating income, and so in our scenario we're dealing with $36,000 gross income. 75% of that, our net operating income, would be $27,000, and we divide $27,000 by the purchase price, in this case $450,000, and we end up with a percentage. And that's 6% in this particular scenario. That's what we refer to as our capitalization rate, or CAP. It's the return on your investment on an annual basis. 6% is pretty decent in our market. In some cases, investors will accept a little bit less because they anticipate increases in rents. They anticipate increases in the value of the property overall. But 6% is a good rate of return. Now, what if we wanted to influence a difference or a variation of that capitalization rate? Well, we have three things to work with. We've got the price, we've got the gross income, and we have the expenses. The first thing that a lot of people look at is, well, are we getting market rents for this property, or could we potentially in the near future increase those rents? That would increase our income. If we did that, that would change our net operating income, divide by the price, and now we get a better rate of return, better capitalization. You could look at expenses. Maybe there's an expense that's currently being paid by the landlord, like water or garbage or something like that, that maybe we can put on the tenants as an expense that they have to bear. Well, now our expenses go down, our net operating income goes up, and that related to the purchase price gives us a better rate of return. And then finally, what if we can negotiate a better price on the property, lower the price? Well, lowering the price in relation to the net operating income, again, is going to give us a better rate of return. All of this has to do with the property and the price that you'd acquire it for. None of it has to do with the investor or their mortgage, right? And that's the purest way to evaluate property and compare properties if you have multiples that you're looking at. And then we do have to look at cash flow to determine whether or not it's a safe investment or safe for you to invest in from an investor standpoint. Because if you can't put down enough money to keep your debt service low enough to have a decent cash flow, and I like to see my clients bringing in at least a couple $100 per month in cash flow, setting that aside for future expenses that might will come up, like new furnaces and roofs and other things that are unanticipated or should be anticipated, should be planned for the future. You should have a little sinking fund set aside. But you know, not everybody has to have cash flow. If you have plenty of extra cash setting aside to make your mortgage payment in case a rent payment doesn't come in, or to pay to replace a $1,500 water heater the next time that happens, well, then you don't need to be cash flowing on a monthly basis. That's okay. You're looking at the opportunity for someone else to be purchasing that property over time for you by covering the mortgage payment essentially, and the appreciation that's occurring in that asset over time. But you have to be in a good financial position, and that really is where it comes down to whether or not you are ready to be a real estate investor or not. And sometimes it's good to partner with somebody. Maybe you individually can't come up with 25-30% down payment, but maybe together with a partner you could each come up with 15. That's possible. And then as a partnership, your partnership is cash flowing. So there's lots of different things to consider, but the key, I think, is separating the performance of the property from your performance as an investor, which is all based upon how much money you truly have to invest. If you have any other questions you'd like to discuss further, the fundamentals of investing in real estate, by all means, please reach out, talk to an MVP broker. We're always excited to have an educational conversation with you. God bless.